David, why don't we talk a little bit about the civil fraud penalties that were mentioned and some of the other scary things that are out there?
Certainly. Following up on what Dennis was talking about, well, first let's talk about what happens when you don't choose to comply by using the voluntary disclosure program. There are people out there that say, I want to do what's known as a quiet filing. A quiet filing means that you fill out the forms and you send them in, but you don't place anyone on notice that you are sending them in accordance with the mandates of the voluntary disclosure program. That type of quiet filing has been viewed as voluntary disclosure ever since the '54 Act. It's not literally in the rules, but it has been an unofficial policy of the Internal Revenue Service that we want to encourage people to comply, and if you comply voluntarily, we will generally refrain from prosecuting you criminally. The problem with that is there is no guarantee, and there are many factors that go into that. And what people are really doing when they do a quiet filing is they're trying to escape any review. With regard to the FBARs, quiet filing does not work so well. First of all, you have a vast number of income tax returns. So if you file an income tax return that you failed to file in the prior year, quiet filing may go through. But the FBARs right now at this time are being scrutinized like never before. And because they are going to a different location and because they are being reviewed much more carefully, quiet filings with FBARs are discouraged at this time. Now, if the program has terminated, as Dennis has alluded, then you have no choice but to do a quiet filing. And under that type of scenario, you are going to subject yourself to the potential of being assessed the full penalty, which is 50% on the FBAR instead of the current 25%. Now, let's talk about the income tax side. Most of the people that are reporting accounts that have earned interest income or dividend income or some type of income that should have been reported on their income tax returns but was not. In fact, under the voluntary disclosure program, if you have an account that, let's use this scenario, you inherited an account, therefore it was not taxable income from the onset, and you held it for a very short period of time, but it did not earn any dividends or any interest. Under the voluntary disclosure program, the IRS would tell you that is not the type of account that they're interested in, and they wouldn't charge you 20% on that account because that account was not an account that was used to evade taxes. The accounts that they're interested in are accounts that earned interest income and nobody paid the income taxes on, or the funds from the initiation that were earned and no taxes were ever paid. They were placed outside the United States intentionally to avoid paying taxes. If you now file those under the voluntary disclosure program, the limit of the income tax penalty is 20%. But if you don't file it under a voluntary disclosure program and do it under a simple quiet filing, then you are facing the potential of being hit with a myriad of civil penalties, including the civil fraud penalty, which can be 75%. So that really is a large deterrent to missing the voluntary disclosure deadline. It's not only the 30% that you save on the FBAR penalty, but it is saving the possibility of 55% in the nature of the fraud penalty and other penalties that could be piled on in addition to the fraud penalty. So that's the incentive with regard to the fraud penalty.